Something is off in the silver market right now, but not in the way most people think. Because if you're only looking at the price, you're already looking at the wrong signal. Right now, silver is hovering around $76, and on the surface, that looks stable, controlled, predictable. But markets don't stay calm when pressure is building underneath. They only look calm right before they move. And the real problem is this: the system that determines that price may already be under stress. Not broken, not collapsed, just stretched. And when systems stretch long enough, they don't adjust slowly, they snap. Now, before you dismiss this as another exaggerated silver breakout narrative, stay with me. Because this is not about prediction, it's about structure. And structure is what markets follow, whether people believe it or not. Let's step back for a second. Right now, silver is stuck between two opposing forces. On one side, you have rising geopolitical tension, energy routes under pressure, trade flows becoming unstable, oil volatility creeping higher. Historically, that pushes metals up. But on the other side, you have interest rates staying elevated, and that does the opposite. It puts pressure on silver. So what you're seeing right now is not stability. It's conflict. Two forces pulling in opposite directions. And as long as that balance holds, price stays trapped. But here's the question almost nobody is asking. What happens when both forces stop fighting and start moving in the same direction? Because that's when markets don't move gradually. That's when they accelerate. Now here's where things start to get uncomfortable, because most people assume the move already happened. Silver ran above $120, then dropped back into the 70s. So the conclusion is simple: the opportunity is gone. But that only makes sense if the system underneath is stable. And this is where that assumption starts to break, because silver is not priced purely on physical demand. It's priced through financial layers, futures, derivatives, paper contracts, which means the price you see is not always the reality underneath. Think about that carefully, because global silver demand has been running ahead of supply for years. Not occasionally, not temporarily, structurally. Every year, more silver is consumed than produced. So where does the difference come from? Inventories, stockpiles. But those are not infinite, and history is very clear on this. When a commodity keeps pulling from reserves for long enough, price doesn't adjust slowly, it adjusts suddenly. And this is where the conversation shifts, not into hype, but into pressure. Because when you break it down, there are three layers of pressure building right now: monetary pressure, physical pressure, market structure pressure. Individually, they don't break anything. But together, they change behavior. Now here's the part most people miss completely. Markets don't move based on what's happening today. They move when something becomes undeniable, not visible, not discussed, undeniable. Now let's take this one step further, because this is where most people stop thinking. They understand supply, they understand demand, but they don't understand timing. And in markets, timing is everything. Right now, silver is still behaving like a normal asset. It reacts to interest rates, dollar strength oil prices. That's why you're seeing it stuck around the mid-70s range recently, even after such a massive move earlier this year, because from the outside, everything still looks connected, logical, controlled. But here's the problem: that logic only works as long as the system stays stable. And the system right now is being pulled in multiple directions. At the same time, look at what's happening globally. Oil prices have surged above $100 in recent sessions due to disruptions in key trade routes like the Strait of Hormuz. And when energy prices rise like that, inflation doesn't just increase, it becomes harder to control. Now connect that to central banks, because this is where pressure builds quietly. If inflation stays elevated, central banks can't cut rates easily. And if they don't cut rates, financial conditions stay tight. And when conditions stay tight for too long, something starts to break. Not immediately, but gradually, then suddenly. This is why silver looks confused right now, because it's caught between inflation pressure pushing it up and high interest rates pushing it down. But here's the shift that matters, that balance cannot last forever. At some point, one side wins. And when that happens, silver doesn't move slowly, it reprices. Now let's zoom out even further. Because the real story isn't just macro, it's structure. The silver market is currently moving toward its 6th consecutive supply deficit. That means for years now, more silver has been used than produced. And here's what makes that dangerous. Production doesn't respond quickly. Because most silver is not mined directly, it's a byproduct. From copper, from zinc, from other metals. So even if demand increases, supply cannot instantly adjust, which creates a silent imbalance, not visible day to day, but building over time. Now combine that with something else, industrial demand. Silver is not just a store of value, it's deeply embedded in modern infrastructure, solar panels, electric vehicles, electronics, and these sectors are not shrinking, they're expanding. So demand is not just high, it's structural. And that creates a very specific condition in markets, inelastic demand plus constrained supply, which leads to one outcome over time, pressure accumulation. Now here's where it gets interesting. Because markets don't react to pressure immediately, they absorb it, they delay it, they ignore it, until they can't. And when that shift happens, price doesn't move based on news. It moves based on realization. Now think about capital. Because this is where most people completely underestimate silver. Global financial markets are massive. Stocks, bonds, derivatives, tens of trillions of dollars. Silver? Tiny in comparison. So what happens if even a small amount of capital starts shifting? You don't need panic, you don't need crisis, you don't need collapse, you only need movement. Even a fraction of global capital can overwhelm the silver market, and when that happens, price doesn't climb gradually, it jumps. This is why silver historically moves faster than gold. Not because it's unpredictable, but because it's smaller. Now, combine everything we've just discussed. Persistent supply deficits, industrial demand that doesn't disappear, macro pressure building in the system, and a market that is structurally small. That's not a normal setup. That's compression. And compression in markets always leads to expansion. The only question is, when does that expansion begin? Now, let's talk about the part everyone is thinking about. But almost nobody understands properly. Not $76, not $100, not even $300. The extreme scenario. And before you react to that, you need to understand one thing very clearly. This is not prediction. This is not hype. This is what happens when pressure meets capital. Because markets don't move in straight lines. They move in phases. Right now, silver is still behaving like a normal asset. It reacts to interest rates. It reacts to the dollar. It reacts to oil. That's why you're seeing it trade in this range. Even after dropping more than 30% from its earlier highs this year. And even major institutional forecasts still point to something similar, roughly around the $80 range as a baseline expectation. So understand this clearly. What you're seeing right now is not extreme. It's baseline. But underneath that baseline, something very different is building. Because the silver market is heading into its 6th consecutive structural deficit. Not 1 year, not 2, 6 years in a row. And since 2021, more than 700 million ounces have already been pulled from global inventories. That's not a short-term imbalance. That's structural. Now think about what that actually means. A market that continuously consumes more than it produces can only survive in one way, by drawing down reserves. But reserves don't last forever. And when inventories keep shrinking, markets don't react gradually. They reprice. Now this is where the transition happens. From normal market behavior to nonlinear movement. Let's break it into phases. Phase 1, normal continuation. Nothing breaks. Inflation stabilizes, rates slowly ease, markets stay functional, silver moves higher, but in a controlled way. $80 to $100 to maybe $150. This is the scenario most analysts are comfortable with. Phase 2, pressure builds. Inflation doesn't fully go away. Energy remains volatile. Central banks delay easing. Now something changes, not panic, but tension. Silver starts attracting attention again, not as speculation, but as protection. And this is where moves accelerate. $150 to $300 to higher volatility. Phase 3, confidence shifts. Now we move into a different environment. Not collapse, not crisis, doubt. Doubt in policy direction, doubt in currency stability, doubt in long-term purchasing power. And historically, this is where hard assets behave differently. They don't just rise, they reprice. Now here's the part. Nobody explains clearly. Silver doesn't need the system to fail. It only needs capital to move, because the size of the silver market is tiny compared to global financial assets. We're talking about trillions in stocks, trillions in bonds, massive derivative exposure, and then silver, a fraction of that size. So what happens if even a small percentage of capital rotates? Not 10%, not even 5%, even less than 1% can overwhelm supply. And when that happens, price doesn't behave normally. It behaves like a liquidity shock. Now let's simplify this. If supply remains tight, demand stays structural, and capital begins to move, then price is no longer determined by production. It's determined by liquidity. And liquidity shocks don't move 20%. They move multiples. We've seen this before. 1970s to explosive, moved 2011 to rapid spike 2025 to over 100% surge in a single year. Now combine that with today's reality. Higher global debt, faster capital flows, tighter inventories. That's why extreme numbers exist, not because they are guaranteed, but because they are mathematically possible. Now here's the real question, not will silver reach $1,000? Will it hit $4,000? Those are outcome questions. The real question is, what happens if the system pricing silver today is no longer fully trusted tomorrow? Because markets don't wait for confirmation. They move when uncertainty becomes too large to ignore. And by the time that shift is obvious, the move is already happening. First CTA, natural entry after high engagement. If you've stayed this far, you're already thinking differently than most people watching the same chart. So if you want more breakdowns like this, hit subscribe. Because this is not about daily price moves. It's about understanding where the system is heading. Now, let's go one level deeper. Because this is where almost everyone stops. They see the numbers, they hear the scenarios, but they don't understand the trigger. And without understanding the trigger, you can't understand the move. Now, let's answer the one question everything depends on. What actually triggers the move? Because without a trigger, pressure can build for years and nothing happens. But when a trigger appears, markets don't wait. They react. And here's the mistake most people make. They look for a single event. A war escalation, a Fed decision, a sudden spike in oil. But that's not how real market shifts happen. Big moves don't come from one event. They come from alignment. Let me show you what that looks like. Oil rises, which pushes inflation higher. Inflation stays elevated, which forces central banks to hold rates longer. Higher rates tighten financial conditions. Tight conditions increase market stress. And stress is where capital starts moving. Now add something else on top of that. The silver market itself is already under pressure, because this isn't just a theory anymore. The market is heading into its sixth consecutive supply deficit with tens of millions of ounces missing each year. And over the past few years, more than 700 million ounces have already been drained from inventories. That means the system is not balanced. It's compensating. Quietly, until it can't. Now combine that with real-world behavior. Because this is already happening. Silver dropped sharply from its highs, but remains highly volatile and extremely sensitive to macro shifts. That kind of behavior is not stability. It's instability. And instability is where repricing begins. Now let me simplify everything into one idea. Silver is not waiting for a reason to move. It is waiting for alignment. When? Monetary pressure builds, supply remains constrained, confidence starts to shift, capital begins to move. That's the trigger, not one event, a chain reaction. And when that chain reaction starts, price doesn't move gradually, it revalues. Now think about this carefully, because this is where most people get it wrong. By the time the move feels obvious, it's already too late, because markets don't reward certainty. They reward positioning before certainty. And right now, we are in that phase, the pressure phase, where everything looks normal, but nothing is truly stable underneath. And this is why silver feels confusing, because the price says one thing, the structure says another, and eventually, only one of those can be true. If this breakdown made you see the market differently, hit like. Because this is not surface level analysis. This is how capital actually moves. And if you're still here, you're not just watching price, you're understanding structure. So tell me this in the comments. Where do you think silver is by 2027? Not what you hope, not what you heard, what you actually believe based on this, because that answer reveals how you see the system. And more importantly, whether you're early or reacting. Session extension, very important. Now before you leave, there's one more piece most people completely ignore. What happens after the move begins? Because the first move is never the full move. And if you understand that, you'll understand why most investors still miss it, even when they're right. Watch the next video, because that's where we break down how the move actually unfolds and where most people exit too early. And once you see that, you won't look at silver the same way again.